Major oil-producing countries led by Saudi Arabia said that they are cutting supplies of crude again, and this time the decision was a surprise and is underlining worries about where the global economy might be headed. A jump in oil prices is threatening to add upward pressure on inflation. In theory, less oil flowing to refineries should mean higher gasoline prices for drivers and could boost the inflation hitting the US and Europe. And that may also help Russia weather Western sanctions over its invasion of Ukraine at the expense of the US. The decision by oil producers, many of them in the OPEC oil cartel, to cut production by more than 1.6 million barrels a day comes after prices for international benchmark crude slumped amid a slowing global economy that needs less fuel for travel and industry. It adds to a cut of 2 million barrels per day announced in October. Between the two cuts, that's about 3% of the world's oil supply. Will the production cut make inflation worse? It certainly could. In the US, gasoline prices are highly dependent on crude, which makes up about half of the price per gallon. The American Automotive Association predicts that the recent production cuts could push US gasoline prices higher.
Short-term spike and the prices start to come down in the not too distant future, that could be a good thing. But if we really do see a huge sort of global shortage where there's a lot of demand for crude oil products, including fuel for vehicles, and that's not there, then that could push those prices up even higher. Reached out to us and they said, hey, what can I do to get more miles per gallon? And of course, we encourage them, get the car tuned up, make sure your tires are inflated to the proper pressure, because if they're underinflated, there's more of that tire that's hitting against the roadway, and that's bringing down your miles per gallon. So it's like you're paying even more for that gallon of gas that you put.